All right, how y'all doing? Welcome to Outside the Box Finances, where we think differently for a better tomorrow. All right, in today's video, we're going to go over how we can take high interest loans and credit cards and utilize them to our advantage. So let's get into it. So right now we have $15,000 at 20% and a credit card at $5,000. All right, now what can we do with that? What's the base that I've been talking about is that the base we should create is the whole life policy. So getting a whole life policy creates the base of our financial system, and then we can go on from there. So with that, we're looking at a $500,000 whole life policy at around $500. All right. Now moving on from this, what people tend to see is that they won't get the $15,000 at 20% because yes, it is pretty significant at 20%, right? And even a credit card at 20%, 22, 23%. It's pretty significant also. But the reason they see that is because that's the first thing they focus on. The whole life policy focus on that premium at $500, which is pretty significant. Right? Not many people, well, not many people, but there are some that can't pay that, or it's a significant amount of their cash flow. And the thing is, with the focus on that, the interest rate and so on, they don't focus on what they can do with the money to make that, I guess, pretty much like negligible. So if you do something with that $15,000, right? You use it for assets that produces a certain amount, are able to produce a certain amount in a fairly quick time frame, and pay that $15,000 off, have profits, then that 20% isn't really 20%. Maybe it's 2, 3, 4, 5, 6%. Because you don't hold it for the whole year. Same thing with the credit card. If you get the interest charge to 0%, then that 20% is negligible because you're not getting charged that 21%. Same thing with the premiums. If you pay it up, then you'll be pretty good. So you got to change that mindset you have and think differently about how you would utilize this. The reason I put a credit card and that high interest loan is because those are typically easy for people to get because one, right? Yes, you can say the company or business that is charged 20%, they're out there just to get people and charge exorbitant amount of interest just so they can make profits. If you had your own business and so on, you would potentially do the same for people who have bad credit or so on, because the main reason why they do that also is because they don't know if that person is going to stop paying it. So they want to squeeze as much as they can before that person stops paying. And if people have bad credit, that means they majority of the time got into a financial rut because they're overspending, buying things they want, instant gratification. That's the reason they got that. So that's what they charge that. So for you, you're going to think differently and not worry too much about that 20%. We're going to worry what we can do with that 50%. And same thing with that credit card and the whole life policy. All right. So imagination, I forgot where I saw it from, but I saw imagination is what is not the determination, but having a good imagination can bring about solutions to problems, or solutions, or solve an issue that's presented if you can if you can imagine something differently than what is just out there. For instance, a lot of proponents would say that's a bad move to get that $15,000 with that 20%, but I say if you can utilize it correctly, then you'd be in a good position to make money. And yeah, blah 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 blah. Same thing for like for housing, real estate and so on. Some people get those short-term, what do they call it, quick loans or hard loans or whatever it is. Those quick loans where they charge like 18, 19, 20% to get the loan quick, so they can use it to close a deal, pay the closing costs and so on, and then they quickly pay it back. I don't know how that whole thing works, but I mean, when I was watching some of the real estate stuff, they were talking about how some people on the finance side do that to earn a little bit of money with the with those quick loans or whatever they call them. Right. So the imagination on with the poor mindset is they can't afford it. Their imagination isn't really out there. All they think about is what's in front of them, what's been said. Pay off this, pay off that. Don't get credit cards. Don't get all kinds of crazy loans and so on. And that's what they focus on. So they stay in this weird area where they can't get out of it because they got to open their mind and think outside the box and see what they can do to actually achieve whatever their goal is. So the rich mindset or wealthy mindset, right? The interest rate, premiums, monthly payments, and so on. Yeah, interest rates and monthly payments become not really irrelevant. Yeah, I mean, still there because if you don't pay off your stuff, then you're gonna have to pay that interest and so on. But it becomes irrelevant in the fact of determining what they want to do with that money. All right, so we're gonna get into it, and I'm gonna show you why it becomes like that. Right, and I'm not even including what you make at work and so on, and yada yada yada. So let's see how we can utilize a credit card at 21% and a $15,000 loan at 20% in our favor, and not get hit with an excessive amount of interest payments, debt, and open up cash flow with this. All right, moving on. So what we're gonna do is we're gonna withdraw that $15,000. Right. So pretty much, if you apply for it, you got. I don't really want to say the agencies because I don't want to hate on nobody and so on and say they suck. But there are businesses and companies out there that you can get a pretty quick loan on. It'll be significantly high. Depending on your credit worthiness, and depending on your credit worthiness, so where your credit score is. All right, but you'll take that. That'll hit you apply for that. That'll hit your bank. And I'm doing $15,000, but when you get also these high interest loans, there's also a fee tacked onto it. Typically, it's maybe 1 or 2%, or maybe they'll charge 1 or 2%, or maybe as high as like 5%. So be wary of that. But right now we're gonna use $15,000. We'll withdraw. It hits our bank. We withdraw it. What do we do with it? Right. I will let you know in a few. Same thing with the credit card. We're gonna do with the credit. We're not gonna withdraw it. We're gonna use it because there are life insurance policies out there that allow you to use a credit card, pay with the credit card. So with both of those, what we're going to do is put it into the whole life, right? Pay those premiums up. The cash value will be $20,000. From there, right, the premiums will be paid up for 30 months. What does that mean? Does that mean for 30 months you don't have to pay that premium because it's paid up already, which is good. So now the premium kind of becomes irrelevant for now for the first 30 months. So that is very, very good. It allows us to focus on other things. From that cash value, right, let's say the rate is 4.75%, you get about a $950 a year, right? And then you'll have a loan also at $15,000, which, well, my bad, you don't have a loan. You'll withdraw from the cash value of $15,000, pay off that $15,000 that was at 20%. That's wiped off, right? Now you got a whole life policy loan at $15,000, and the way my company works that I'm with, it's 1% above the gaining interest rate, which is which we got right here at 5.75%, which is $863 a year, right? And that's simple interest. So as long as you pay that, it doesn't compound. And that $950, right, is you gain at the end of the year, and it's compounded every year. Not monthly or whatever, it's every year. So eventually, right, what exceeds it, the net is positive, but the net positive will keep growing as time goes on. All right. Now we only withdrew $15,000 because you only can withdraw up to 75%. At least that's how it is with my company I'm with. So you use it, pay that off, but now you got a cash value of $20,000 in there, getting some interest where you could have possibly and paying 5.75%, but the difference is about what 1%. So You could have been paying 20%, but no, you're paying that. But that difference right there is still, right? The cash value interest gain is still more than the whole life policy interest that it's taking. So it's covering each other. So you're in a good spot. You're earning some money even though you have a little bit of debt. From there, we haven't seen, right? What about that credit card? Right? The credit card still has a balance of $5,000. So let's see what we're gonna do. If you have a pretty decent credit score, at least a credit score to get a decent credit card, one with a balance transfer and an introductory rate of 0%, then we can move that balance over to that new card, and that previous credit card, the initial one, the balance is at 0%. So right now, you're in a pretty good spot. So from here, what do? From here, that balance at $0, we'll take it, right? You'll put it into the cash value. Now you have 25,000 cash value, gaining at 4.75%, which is 1,187 a year. And your whole life policy loan is still at 863. Right, now you got a balance on that one. Guess what are we gonna do? Same thing. See if we can get another credit card at 0%. Right, now that previous credit card is still at 0. Now on this one, there's a balance of 5,100 because of that balance transfer. I think I put it at 2%. Yeah, 2%, which is $100. So 5,100. Right. So that means you get 26,800 now in the cash value, because we're gonna again use your credit card to put another a little bit more amount in there. Not the full 5,000. We're gonna put about 1,800. I'm gonna show you why. So now you gain about 1,268 per year. Why are we gonna? Now what else are we gonna do? Not why, but what else are we gonna do with the money or the credit that's left over on that credit card? Are we gonna just leave it, or are we gonna use it? We're gonna utilize it. We're gonna get another whole life policy, and what's gonna happen is you want to get it on another person, because the way my credit card company does it is you can use up to $5,000 per credit. Oh, $5,000 on your credit card per policy. They don't allow more than that. So if you open up another whole life policy on somebody else, then, right, you can utilize additional credit from the credit card. Right. So from here, we open up a whole life policy on somebody, a significant other, kids, somebody you have a vested relationship, I think, or yeah, vested relationship or something like that. So for instance, your kids, right, they rely on you and so on. So you can get a life insurance policy, but you can't just go out there and be like, choose someone off the street and be like, hey, let me get a whole life policy on you. One, they're gonna look at you and be like, what are you trying to do? Do something to me? Because why are you trying to get a whole life policy on me? And two, right, you have no vested interest in that person. Right? But moving on. So whole life policy at $100K. About $110. Use the remaining balance from the credit card, which will be about $3,400, which now become the cash value when you pay up those premiums, and that'll be paid up for 30 months. So now you got 2 whole life policies, cash value in them, paid up for 30 months. And the thing is, it grows as if you never touched it. So even though you're like on the $20,000, you're holding the $15,000 whole life policy loan, it's still growing at the $20,000 as if you never touched it. So you're in a good spot. So that $3,400 growing at that 4.75% per year is about $161. So from here, what are we looking at? We're looking at a whole life policy at $500,000, $100,000 paid up for 30 months. Now it's paid up. So for 30 months, the premiums you don't got to worry about. All right. From here, we got 2 policies with cash value, one of $26,800, the other one of $3,400, both gaining at 4.75%, right? Earning 1,268 compounded yearly and 161 compounded yearly. Then of course we got the whole life policy loan at $15,000 at 5.75%, 863, which is simple interest. But what it's gaining is covering and exceeding the 863. So we're in a good spot. Now we got 3 credit cards, each holding a balance on them. Right? Well, except one credit card. Hold up. No, because we paid it off. Yeah. So we got 3 credit cards, each holding a balance. The other ones are a little bit higher because of the balance transfer. If you can, get the payments staggered. You don't have to do it, but the main thing also with this, and what I'm going to show you, is to look at your statement, and when you get it, see how the interest is calculated and see what needs to be paid off. Right? So what I mean is, a lot of times on there it'll say you get a, what do you call it, a grace period. As long as you pay it off by the payment date, or as long as you pay it off, by the payment date, they'll charge 0% interest. But like for my credit card, what it does is, as long as you pay, right, you make payments up to what the previous debt was from the previous statement period, then you're good to go. So even if I heard a balance and the the due date hits, right, I'm good. So you got to focus on that and make sure that it says the same thing. And if you don't understand it, or when you call them you don't understand it, then you got to use a little amount of money and actually test it. Like you're almost like a scientist. You think of the theory, right? You test it out, and then you see what the result is. If the result is what you thought, then you're good. If it's not, then you have to find something better, or think of something else, right? So a lot of this I'm basing off what I'm doing, or it's based off of what I'm doing. Right? But here, this is what we're going to do. So if we hold those balances, right, we're going to have to pay interest. So how do we alleviate this stuff? So what we'll do is we'll withdraw $5,000 from the whole life policy. Right? And then from there, what we'll do is pay off that CC balance at $5,000. Okay? So from there, what will we do when we pay off that $5,000? Now we have a credit card with no balance. So with the staggered payments, pay it off and it'll show 0, and then once the due date hits, you're good to go. Now if it works the way I do, then as long as you pay that previous balance of $5,000 off, right, and even if you still hold a balance, you're good. But right there, you pay it off, due date hits, you're cleared of that, so you get no interest charge. Then from there, right, you use it to pay the whole life policy off. Okay. Then from here, what do you do again? You withdraw the $5,000. And then from here, you pay the premiums, $3,500, which goes into where? Right? One of the whole life policies. Because what you want to do with the whole life policy is have enough in there where you can withdraw $5,000 at a time, since you can utilize $5,000 on the credit card. But you pay the premium $3,500. Then you're able to withdraw $5,100. Why? Because the transfer of one of the credit cards, the transfer. Put it into that new credit, pay off that $5,100. Then again, you hold it, or you pay it near the payment due date. Payment due date comes. There's no interest charge. Then you utilize the credit card. You pay off the whole life loan. Then you withdraw another $5,100 for that other card. You pay the whole life loan, and then you just keep rinsing and repeating. Keep doing it. Now, the thing about this is that you got to maintain and keep track of what you're doing. You can get easily lost in the sauce when doing this, because there's a lot of movements taking place. And if you mess up here and there, you'll likely be fine. But if you mess up too many times, then you're going to collapse the system. So ensure you don't. Right? The premiums, you got to do no more. Right? But the cycle still keeps going on. So what do we got? We got a cash value of 26,800, blah blah blah. So the net from that is $405. This is the interest, and then basically, if you want to use interest, you can take out 75% of it, which is 303, which we can utilize, and I'll show you why we would utilize it or how we would utilize it. And you got the credit card rewards because I didn't explain that, but you will get rewards. But my credit card offers 1% rewards, and that's about 150 points. So the total is 453 that you can utilize. Right, a little bit more than that because that's yearly and the other one's monthly, but we'll say 453. So I keep bringing up a lot about the Forex. Forex, I think, is one of the moves you can make that quickly grow your account. You got to be mindful of it. There's a lot of risk with this, and I'm not encouraging joining the Forex because you can have a lot of financial issues with the Forex, especially if you want to go YOLO and try to make thousands and thousands and millions of dollars within a small time frame. But if you utilize correctly, you can grow your account pretty quick and significantly. So from here, with the 5,000K position, which is units, which is about $270 in margin, right? Per day is $1.05. So for 365 days, just times that, and it's a pretty decent amount. Well, that's $0.05. The RI is rollover interest, and then per pip move. So if you equate it to stocks, it's like every penny that it moves, but in pips, it's four places from the decimal. But it's 14 cents per pip. Now, the Euro Huff can move fairly significantly, like thousands of pips, so you might want to be careful with this and how much money you put into it. But if we're looking at this, right, and we can maintain this with the 270, right, we're looking at an 84% gain if we utilize the $453 in the first year. Same thing for the second year, third year, and fourth year, and fifth year. And the fifth year, we're looking at 19K. Is it doable? Yes. Are your emotions and yourself going to let you hold that to that extent? Probably not. It's going to be very difficult. Now, of course, we can factor in the risk that's in there. What happens if the position we're in moves against us? Right? So what happens if we move the 1,000 pips against us, which would be a pretty significant move. Right? Well, how would it look like? The account will be able to sustain this, and we're looking at a 53% gain instead of 80% gain. I'm sure you'll probably be upset because you want the 84%, but in my eyes, 53% does still look very good. So instead of 836, 693. Still pretty significant. And in year 5, we're looking at 9.4K from a small amount. Now, understand I'm using 453 added into there per year too. But let's do 500 times that by 5 for the 5 years. That's 2,500. All right, 9.4K is still a significant amount gained from 2.5K. So we're looking good. Now, what's next? What happens? Let's say this. What happens if this thing just totally collapses? You put that $453 in there, and by year 4, 3, whatever, it just collapses. All right, you're gonna be distraught, upset, angry, but it's almost irrelevant. And the thing is, did you really lose? Right? Did you really lose? So there's a story I read in How to Trade Stocks by Jesse Livermore. Right? He was in the 1900s one of the very famous stock traders, right? Swing traders, and traded his own account and made hundreds of millions of dollars. But one of the stories I heard from him or I read in the book was that there was a guy who went to the racetrack. He had $2, and what he would do is he got that $2. He would bet on a horse, and then he would win. And he would double his money each time. So each time he bet, he made right. He bet $2. He made $4. He made $8. He made $16. He made $32, $64, and so on. Da, 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 da. Up until he had $1 million, well, almost $1 million. He wanted $1 million, so he betted it again, right? And at that time, he lost. He lost everything. And what happened after that time? He left, right, the racetrack, and then he saw a friend out there, and the friend met him. He's like, "Oh, hey man, how's it going on?" He's like, I'm doing all right." The friend's like, "Oh, the racetrack, you win anything?" He's like, "Nah." And the friend's like, "Oh man, what happened?" He's like, "Oh, nothing. I just lost $2." Right? Did y'all get that? The thing is, he's never had that money that he gained. It was never there. He gained it. So if he lost it, it's really like if he never had it, because that was money he never had it before. Now, I mean, the thing is, if you're starting to live off what I'm showing you right now, you're not really living off it. You're still trying to gain. So if he lost it, he never really, really lost it. And there's other aspects to make sure that it's not as if you really lost it. But in this aspect, the only amount of money he lost was the amount of money he had put in from his like principal. And the money that we were using is not from the principal, it's from all the interest gained that was never there. Hopefully I'm explaining this well. So from that, even if he lost that, I mean, what's still out there? We still got a cash value gain interest, because it's as if he never lost it. He's still getting interest off that $26,800. Right, he has a future net worth protection because he has that $500,000 and $100,000, total of $600,000 of life insurance. So if something were to happen to him or whoever he put the $100,000 on, right, they'll be able to get that money. He's collecting rewards off his credit card. He also has a credit card benefits if he wanted to use the credit cards for something, right, like the extended warranty and so on. And the main thing about this is he's collecting knowledge and experience. So now that's in his mind, his tool bag, and it's not going to go away. So now he knows what to do and get better. Right? And a lot of people want to gain knowledge but want to shy away from experience. So don't be that one. Improve your mindset, right? And ensure you think differently about how things are going. Right? Hopefully this helped y'all. Thank y'all for joining me. And until next time, talk to y'all later.